Hello and welcome to Session 9 of the Basic Tax course. We begin Session 9 with a review of the Session 7 quiz answer key. I have in front of you now the Session 7 quiz, and I'll scroll down to one of the more frequently missed questions. The first question I'm going to review is question number 6. You can claim a deduction for your interest expenses on money you borrowed to buy tax-exempt securities. Well, that is a resounding false. In fact, interest paid to purchase tax-exempt securities is specifically listed as an item that is not deductible in Pub 17. Moving on to the next question, question number 11. You must fly your dependent child to San Francisco for special treatment not available in your home city. What medical expenses can you deduct? It lists a variety of different choices, but we go back to the rules about deducting travel as a medical expense. And if you recall, you don't get to deduct the cost of meals. You do get to deduct $50 per person per day, provided it's not lavish or extravagant. And so essentially, of course, the medical bills themselves are deductible, the hospital stay and so forth for the dependent child. And the cost of the person who accompanies the child is also deductible. So we're talking $50 per person per night for lodging and the hospital and medical bills and the cost of travel. So that would leave us with answer number A as being the correct choice. D is wrong because it's $100 per person per night. That's false. C is wrong because it includes the cost of meals. That is not allowed. And B is wrong because it allows, again, $100 for the cost of lodging. So moving on, the next most frequently missed question. Question number 14. Mr. H makes payments on a seller-financed mortgage. Since he did not receive Form 1098, he must provide the name, address, and Social Security number of the person to whom he makes the mortgage payments on Schedule A. That is a true statement, and of course we covered that in depth in our last two classes. And if we go over to Schedule A here, this is for the mini problem, but I just wanted to point out the line. You'll see that line 11 is where you enter the name, address, and Social Security number of the person that you are making payments to, and you use this section when you do not have a 1098. You can see it says right here, home mortgage interest not reported on a 1098. You need to fill it out on that line. Moving on, number 16. Political contributions made to a political candidate or a campaign committee are deductible as a charitable deduction on Schedule A. That is absolutely false. Political contributions are never deductible at all. And you do have to be aware that when you make a contribution to someone who is political, that it's not deductible. Now, at the state level, some states may allow tax credits for certain types of political contributions, but that is a state issue. It is not allowed at the federal level. And, of course, campaign contributions that are received by political candidates are not taxable if they're spent on campaign expenses, but it doesn't make them deductible to the donors. As a donor, you can claim a deduction for contributions you make to a registered nonprofit organization that qualifies for special tax-deductible status, and political candidates and political campaigns never qualify for that. You should be aware that there are some organizations, such as Greenpeace and the Sierra Club, that have been deemed to have political motives, and although people contribute to them regularly in the belief that they are deductible as charitable contributions, those are examples of two organizations that do not qualify for tax-exempt treatment because they have been deemed to engage in political activities. And this is not an opinion against either of those two organizations. It's just two organizations that come to my mind as being political and therefore non-deductible. Moving on, we've got the mini problem. And the mini problem, the biggest problem people had on the mini problem, and I have the answer key right here, was the amount to enter on line 15. And the correct answer is $15,800. And that is because we were only able to deduct investment interest to the extent of investment income. But let's just go over and take a look at the problem in whole, and then we'll return to the Schedule A that was completed for Donald Duck and Daisy May. And we can see that they had the following expenses for 2010, including pre-tax medical. Is that deductible? No, it is not. Prescription copays, is that deductible? Yes, it is. Reading glasses, deductible. Dental visits are deductible. And medical miles are also deductible. You would take 250 miles and multiply that out by 16.5 cents. 250 times decimal 165 equals $41. So the deduction allowed for mileage ends up being $41. And so you take $200, $300, $250 plus 41, and you get the deductible amount of medical at $791. Well, of course, that is far less than 7.5% of the income, and so the ultimate medical deduction for Donald Duck is 0. Moving on to the next line of the tax return is income taxes and other deductible taxes. Well, Donald had a number of deductions. The first one is $6,000 of withholding on his W-2, but he also had these state estimated tax payments. And since all of these payments were made during 2010, they are all deductible on the 2010 return. And of course, these numbers add up to $1,900, and we add those to the $6,000 showing here, and we end up with $7,900 as the deduction. Property taxes of $4,000, those are deducted on line 6. And then, of course, the margin interest was $1,000, but in the wording of the problem, we tell you that included in their taxable income was $400 of interest income and $400 of dividend income. You take those two numbers, you add them together, and you get $800. And remember that margin interest or deductible investment interest cannot exceed investment income, and therefore the deductible amount to enter on line 14 is $800. Of course, 4952 would need to be completed. It was not a part of this quiz assignment to complete the form, but the form is required, and I just wanted you to know that. Then we move on to the next part of the problem, which was to complete Form 8283 for Donald and Daisy because they made some contributions to charity. So let's just scroll down to their completed form and compare those to the items that we have listed here. There was a donation to Goodwill of used clothing. The cost on that was $1,500. The fair market value was $400. So we've entered those two amounts on the 8283. We then had cash contributions to church. Cash contributions to church would not go on Form 8283. They go directly on the Schedule A. The used Jetta, the cost was $10,000. The fair market value is $4,000, and we arrived at that fair market value because that is the amount that the car sold for at auction. And of course, in the mini problem, we did give you the 1098C form showing you the amount that it sold for at auction, and that's how we arrived at the number to enter on line 1G. And of course, the sales price is the method used to determine the fair market value. And then finally, home mortgage interest, that was a relatively simple number that goes directly on the Schedule A. We're telling you that it was reported on a 1098, so it's not necessary to complete line 11. Line 11 is completed when you claim the deduction for mortgage interest that is not reported on a 1098, although we did not show you the 1098. We told you that it was reported on one, so that number would get reported on line 10. So total deductible interest to enter on line 15 is $15,800. Here is the cash gifts to charity. Here is the non-cash gifts to charity that were reported on Form 8283. And, of course, the final amount reported on the 8283 was $400 to the public library. Cost $200 is the fair market value. When we added up all of the items that were non-cash, we ended up with $4,600 for a total charitable deduction of $6,100. And on line 29, we show the total itemized deductions at $33,800. So that completes the review of the Session 7 quiz answer key. Next up is a review of the Session 8 homework assignment. And here is the homework assignment from the Session 8 manual. Jonathan Livingston is married to Joanne. They have a daughter, Tracy, who was born in 1983 and is not a student. She lived with her parents all year and earned $4,500 during 2010. Well, since she's not a student and she's age 19 or older, she needs to have less than $3,650 of income to qualify as a dependent, and since her income is $4,500, she is not a dependent on the tax return. Jonathan works as a flight instructor for 2 different employers. He works mornings in Des Moines and afternoons in Windsor Heights. And he did that for the entire year. His commute miles in 2010 totaled 5,500, and round-trip distance is 22 miles. He drove from his job in Des Moines to his job in Windsor Heights 6 miles, and from his job in Windsor Heights to his home 6 miles, 250 times during the year. Jonathan drove his car a total of 15,000 miles in 2010, and he began using his car for business in January of 2008. Jonathan also drove his car to a pilot instructor school in Davenport on September 15. The round-trip mileage was 338 miles. He stayed 2 full days and nights in Davenport and spent $94 on meals. The school cost him $500 and the hotels cost $200. The Livingstones have no employer-provided medical plan. Their medical insurance premiums for the family were $7,176 in 2010. They also paid $3,200 for Tracy's eye surgery during the year. Jonathan and Joanne own their own home. Their 1098 mortgage statement shows $8,000 of mortgage interest and $2,500 of property taxes were paid during the year. The Livingstons will receive a Making Work pay credit in the amount of $800. Their W-2s are attached to prepare their return. So moving on, we have a W-2 for Jonathan Livingston showing $24,000 of income with Happy Airlines. We then have Right Way Tax Service, who is employing Joanne Livingston, $20,000 of income on her W-2. And then, of course, Jonathan Livingston had one more W-2 in the amount of $15,000 from the Windsor Heights School of Flight for $15,000. Let's prepare their tax return. So here is the answer key for the homework assignment for the Livingstons, and the first thing you should know is that Jonathan and Joanne are going to be filing a joint return. At least that was our evaluation. That would be the best choice for them. Their daughter fails the gross income test, as I've already said, and cannot be claimed as a dependent. However, the Livingstons can claim her medical expenses. So the next item in line that we have to look for Jonathan is the business miles that he drove. And he made 250 trips times 6 miles from his main job to his second job, and the deduction for that is 50 cents a mile. So ultimately, 250 trips times 6 miles equals 1,500 miles times 50 cents a mile equals a deduction of $750. Then we have 338 miles that was a separate trip to Davenport at 50 cents a mile, and that's an additional $169 deduction. Now, all of the miles that were driven from home to the second job are considered personal commute and are not deductible. So we're going to take 750 plus 169 gives us $919 of deductible mileage for the year. We also have to report Jonathan's business use percentage on his car. Form 2106 asks for that. So we look at the total business miles that were driven for the year, 1,838, and we divide that by the total miles. And we find out that Jonathan's business use is 12.25%. Now note that commute miles are provided to the IRS for informational purposes. Commute miles are a portion of personal miles and are not a portion of business miles. And I believe that the reason IRS actually has you put commute miles on the form is so that you don't include them in the business mileage portion. So they're just calling your attention to the fact that business miles and commute miles are two different things. Jonathan is better off claiming the actual cost of $94 for meals rather than the per diem allowances of $46 a day, so we're going to give him the $94 deduction. Figure Jonathan's Form 2106 entries as follows. Auto expense $919, local transportation expenses were $0, travel away from home, that was the hotel cost, $200, other expenses, which included the cost of attending the flight school, were $500, and meals, $94. Now, it is possible that you may have decided to take 2 nights at $46 a day and then work on, well, what about the days of travel? Does he get 3/4 of a time for each of those? Those are all valid issues. Just for simplicity's sake, we want you to look at it. If we're saying it's 2 days, just figure the per diem for 2 days and don't worry about travel days. We're trying to keep this simple. Obviously, in the real world, if you had a client that was spending a lot of days traveling during the year, the travel day computation would become fairly important. But for Jonathan, we simply said, how many days was he traveling? It was 2. 2 times 46 is going to give us a lesser number than the actual cost of meals at $94, and that is what we went with. Next up, Jonathan can claim $10,376 in medical expenses, so let's just see where that came from. He had insurance in an amount of $7,176 plus the cost of his daughter's eye laser surgery at $3,200, and that is the total medical deduction of $10,376, where we got that number. Next up, we have the Jonathan's mortgage insurance, and real estate taxes and the local income taxes, and those all get entered on Schedule A. So let's look at the finished return for the Livingstons. We can see that we have a married filing joint filing status, 2 exemptions. The wages reported on the W-2s totaled $59,000. And moving down to the Schedule A, we show the medical expenses, we show adjusted gross income. 7.5% of adjusted gross income is $4,425. We subtract $4,425 from $10,376, and we get a medical deduction of $5,951. Income taxes showing on the W-2s were $3,375, and we have real estate taxes of $2,500. So the total income tax and real estate tax deduction shown on line 9 is $5,875. Mortgage interest of $8,000 goes on line 10. And then we move down and show that we're carrying over $1,666 of expenses from Form 2106. We have to apply a 2% limit at this point, and that's $1,180. So the deductible amount of employee business expense is $486. But let's go take a look at Jonathan's 2106. And I did want to point out that 2106 is one of the forms that is allocated to the individual who had the employee expenses. So when you're dealing with a taxpayer and spouse, you don't share both the taxpayer and the spouse on the same Form 2106. You would put business expenses of the spouse on the other Form 2106. Just a little tidbit I wanted to throw in. So here is the vehicle expense. That was figured using the standard mileage rate. Here on line 3 is the cost of lodging. On line 4 we have the cost of attending the school. Those amounts add up to $1,619. We then have $94 of meal expense. We have to apply the 50% limit, and that reduces meals down to $47. We then add $47 to $1,619, and we get $1,616, which carries to the Schedule A. And here we have the entry on Schedule A. Moving back up to page 2 of the Form 1040. Total itemized deductions are entered on line 40. They were $20,312. We have personal exemptions totaling $7,300. Taxable income is $31,388. The income tax shown in the tables is $3,869. So we show $5,000 of withholding on the W-2s for federal income tax withholding in the 3 forms W-2. We have $800 of making work pay credit. So total payments and credits are $5,800, and that leaves the Livingstons with a refund of $1,931. So that concludes the review of the Session 8 homework answer key. At this point, please push pause, take the Session 8 quiz, and when you are ready, resume playback for the Session 9 lecture. All right, and we are ready to begin the Session 9 lecture. Today's lecture will cover non-business casualty and theft losses, miscellaneous deductions, and the alternative minimum tax. Just to orient you with Schedule A, so far during the last 2 classes, we discussed medical expenses, deductible taxes, deductible interest, deducting gifts to charity. We also talked about miscellaneous itemized deductions for employee business expenses that are claimed on line 21. Today we're going to be looking at casualty and theft losses, which are claimed on line 20 of Schedule A, as well as other miscellaneous itemized deductions that can be claimed in this bottom part of Schedule A, including line 22 tax preparation fees and line 23 other expenses, including investment sale, deposit box, etc. And we're also going to be talking about other miscellaneous itemized deductions that are claimed on line 28 and are not subject to the 2% limit. We'll start first with non-business casualty and theft losses. Casualty losses. You may be able to claim a deduction for a casualty loss. To be deductible, the loss must be sudden, that is, an event that is swift and not gradual or progressive. Unexpected, that is, an event that would not normally be anticipated and is unintended. And unusual, that is, an event that is not a day-to-day occurrence and is not typical of the type of activity in which you are engaged. Let's talk about theft losses. A theft loss is the taking and removing of property or money with the intent to deprive the owner of it. The theft must be illegal under the laws of the state where it occurred, and it must have been done with criminal intent. Theft includes the following acts: blackmail, burglary, embezzlement, extortion, kidnapping for ransom, larceny, and robbery. But theft does not include lost or mislaid property. However, an accidental loss or disappearance can qualify as a casualty if it results from an identifiable event that is sudden, unexpected, or unusual. Loss on deposits. A loss on deposit occurs when a bank or financial institution becomes insolvent or bankrupt. If you incur this kind of loss, you can deduct your loss in any one of the following 3 ways: as a casualty loss, as an ordinary loss, as a non-business bad debt. Now, how do you go about claiming losses on deposits? Well, there are, as I said, 3 different ways. If you claim your loss as a casualty loss, you will report the loss using Forms 4684 first, and then you will carry the deduction to Schedule A on line 20. If you claim the loss as an ordinary loss, you report the loss on Schedule A, line 23. And if you report the loss as a non-business bad debt, you will report the loss on Schedule D of Form 1040, and we will learn more about Schedule D when we get to our sessions on capital gains and losses. So the best way to really introduce you to the concept of when we have a casualty loss and when we do not is to refer to some of the examples that have been provided in Pub 17 of when IRS deemed that there was a casualty loss, and other examples they have provided of when a casualty loss has been disallowed. So let's take a look at these. The first one's in the allowed column, or the casualty losses that have been considered to be casualty losses in the eyes of the IRS, include car accidents, earthquakes, fires, floods, government-ordered condemnations resulting from natural disasters, hurricanes, mine cave-ins, shipwrecks, sonic booms, storms, tornadoes, vandalism, volcanic eruptions, damage caused by insect infestations incapable of destroying a tree in 5 to 10 days. And you might say, well, what in the world is that? It's actually something I remember hearing about on the news a few years ago. There are these enormous Asian beetles. They're about yay big with spots on them, and they got into the United States in some shipments, probably in plywood crates. And they are just voracious with no natural predators here in the United States, and they can infect a tree and kill it in a matter of days. So if you've been unfortunate enough to have that happen to you, that is deductible. Death of a horse who swallowed a hat lining has been allowed. The cracking of house foundation walls caused by soil shrinkage during a drought has been allowed. The collapse of a garage wall from subsoil hydraulic action. Damage caused by mine cave-in, even though the landslide was reasonably foreseeable. Bursting of hot water boiler in a home. Damage to furnace dropped by movers. Damage caused by a flood due to faulty construction. However, the deduction was limited to the cost of the items damaged, not for the cost of the reconstruction. Any damage caused by lightning is allowed. Damage to a ring inadvertently dropped in a kitchen garbage disposal was allowed. Damage to a ring caused by a door slamming onto it was allowed. Damage caused to the septic tank by plowing was allowed, as was damage to a beach due to abnormal rains, and damage to a home by an ice and snow. Damage to a home caused by a hurricane 2 years earlier was also allowed, but the damage was deductible on an amended return for the year in which the damage occurred. Damage from floodwaters caused by storms. Damage to trees and shrubs caused by accidental chemical poisoning. So if you're not paying attention to what you're doing and you accidentally poison your plants, IRS is saying that's sudden and unusual and is allowed. Also, damage to trees caused by storms and blizzards is allowed. The loss of trees, grass, and shrubs from fire is allowed. Damage to household items caused by vandals who broke into the home is also allowed. And damage and destruction of art objects by vandals has been allowed. But let's look now at the list of what the IRS has not allowed. we'll see that this list includes accidental breakage of household articles such as glassware and china under normal conditions, damage caused by a family pet. Now, family pets causing damage is not unusual, and it's generally not unexpected, but it could be swift. So if we're looking at 3 tests for meeting casualty loss, we're looking at sudden, unexpected, and swift. Sudden being, unexpected, swift, and unusual. Okay, so sudden, unexpected, and unusual. Damage caused by a family pet would be sudden, but it would not be unexpected or unusual, and that's the reason it was disallowed. Damage caused by a fire that you willfully set or paid someone else to set, well then that wouldn't be unexpected, would it? A car accident caused by your willful negligence or neglect, that would probably not be unexpected either. Progressive deterioration such as the steady weakening of a building due to normal wear and tear. So what they're saying is if you've got a building that over time is degenerating and needs repairs, that's not an allowable deduction because it is not unexpected, it is not sudden, and it is not unusual. So it loses on all 3 counts. Damage to a water heater that burst after it deteriorated over time also was not allowed. However, damage to other property caused by the burst of the water was allowed. Most non-business losses caused by drought are also not allowed. Well water that ran dry because of drought is not allowed. Drought is typically not sudden or unusual. It happens, and that's what we're looking at there. Damage to shrubs eaten by a horse, not allowed. Damage to an antique vase by a cat, not allowed. These things would be sudden, but they would not be unexpected or unusual. Pets break things all the time. Damage to fur coat caused by moths also was not allowed. A loss of a valuable dog that strayed off, also that would not be unusual. Damage caused by normal wear and tear of a car, again, not allowed, not sudden or unexpected. Damage to car caused by overloading the vehicle. It might be sudden, but it certainly would not be unexpected. Damage to car caused by exposure to salt water. Also, that is something that is reasonable to expect, and proper precautions could avoid that, so that's obvious why they're not allowing that. Amounts you pay someone else to compensate for your negligence. For example, a woman paid the owner of a house for damage she caused when she actually accidentally drove her car into it. The IRS said no to that. The forced sale of a car due to divorce, not allowed. Damage to a car caused by potholes in the road. Now, I personally feel that potholes cause a tremendous amount of damage to cars, and when we have city governments and federal governments that don't keep the roads in good repair because they don't want to spend the tax dollars, well, we as taxpayers pay for those costs through repairs to our vehicles, but they're not deductible. Sale of items by a storage company because you did not make payment. This event, again, is not unexpected. Storage companies, when you sign the lease with them, clearly tell you that they will sell your stuff and auction it off for money if you don't pay the rent. The loss of a ring from an owner's finger, that's not unusual. The loss of a ring you accidentally threw out, well, too bad. The accidental dropping of your eyeglasses or watch, also not unusual. The loss of baggage or contents in transit, well, we know that is quite normal and not unexpected. The snapping of a propeller on a yacht that was not the result of a shipwreck or casualty also was not allowed. Damage to trees from Dutch elm disease. This disease is progressive and not sudden or unexpected. The gradual suffocation of a tree's root system over a 16-month period, also not allowed because it was not sudden. Damage to palm trees caused by lethal yellowing was not allowed. Termite and moth damage not allowed. The death of a horse from colic is not allowed either. And those of you who are familiar with horses, which I am, I happen to love horses a lot and have 3 of them, the death of a horse from colic, that's actually one of the single most common reasons that a horse will die is colic. So although it is sudden and unexpected when it happens, it is not unusual, and that is why the IRS does not allow it. But we compare that to the horse who swallowed a hat lining. That would be unexpected and unusual for a horse to swallow a hat lining. And finally, the loss of livestock due to disease, that is not unusual and is not allowed. I'm going to give you now the first password of the day. The password to open the Session 8 homework answer key is Tokyo. So that's the city of Tokyo in Japan, Tokyo. Let's look now at what we need to prove a loss. We've gone through a list of the types of things that are allowed and not allowed as casualty losses. Now we need to go and talk about what kind of proof you need to be able to show that you had a loss. Firstly, for casualty losses, your record should show all of the following: the type of casualty and when it occurred, that the loss was a direct result of the casualty, that you were the owner of the property or that you were contractually liable for the property, and whether a claim for reimbursement exists for which you expect any recovery. For theft losses, your record should show all of the following: when you discovered that your property was missing, that your property was stolen, and that you were the owner of the property. Now that we know what kind of records you're supposed to show, let's go about figuring the allowable loss that you are allowed to claim. You figure your loss as follows. You determine your adjusted basis in your property before the casualty or theft occurred. You then determine the decrease in fair market value of the property as a result of the casualty or theft, and from the smaller of your basis or the decrease in fair market value of your property, subtract any insurance reimbursements you receive. Fair market value. The fair market value is the price at which the property would be sold between a willing buyer and a willing seller, each having knowledge of the relevant facts. Difference in fair market value. The difference between the fair market value immediately before the casualty or theft and the fair market value immediately after represents the decrease in fair market value because of the casualty or theft. So, in figuring your allowable loss, you're looking to the smaller of your basis or the decrease in fair market value. And to figure your decrease in fair market value, you look at what it was worth on the date of the incident and how much it was worth after the incident. And the difference between those two amounts becomes the decrease in fair market value. The allowed loss is going to be the smaller of your basis in the property or the decrease in your fair market value. So again, difference in fair market value. The difference between the fair market value immediately before the casualty or theft and the fair market value immediately after represents the decrease in fair market value because of the casualty or theft. The fair market value of property after a theft is zero if the property is not recovered. The fair market value is generally determined by a competent appraisal. Replacement cost or the cost of repairs is not necessarily the same as the fair market value. However, you may be able to use the cost of repairs to the damaged property as evidence of the loss in value if the repairs were actually made, the repairs were necessary to restore the property to the condition it was in immediately before the casualty, the amount spent for repairs is not excessive, the repairs only correct the damage caused by the casualty, and the value of the property after the repairs is not, as a result of the repairs, more than the value of the property immediately before the casualty. Loss on real estate. To figure a casualty loss to real estate not used in a trade or business or for income-producing purposes, you must measure the decrease in the value of the property as a whole. All improvements such as buildings, trees, and shrubs are considered together as one item, but you figure the loss separately for other items. For example, figure the loss separately for each piece of furniture. So going back to a casualty loss on a home, you have the house itself that's damaged. You might have a bunch of shrubbery or decks or patios that are also damaged at the same time, and the IRS says just take all of that as a single item. But if inside the house you have a dining room table and a bunch of clothes and you've got your CD collection and so forth, they want you to list those items out separately. So listing all of those other items out separately could be quite time-consuming and require a lot of subsequent pages to your tax form if you think about it. Separate computations. Generally, if a single casualty or theft involves more than one item of property, you must figure the loss on each item separately, then combine the losses to determine the total loss from that casualty or theft. There is an exception for personal use real property. In figuring a casualty loss on personal use real property, the entire property, including any improvements such as buildings, trees, and shrubs, is treated as one item. Figure the loss using the smaller of the following: the decrease in the fair market value of the entire property and the adjusted basis of the entire property. For deduction limits, once you have figured your loss, you must complete Form 4684 and apply the following deduction limits. Under the $100 rule, you must reduce each casualty or theft loss event that occurred during the year by $100. There is also a 10% rule. You must reduce the total of all of your casualty or theft losses by 10% of your AGI. Here is an illustration of how those limits work. Illustration number 1. Your boat was stolen and your boat cost you $20,000. Its fair market value on the date that it was stolen was $15,000 and your insurance paid you $13,000. Your adjusted gross income for 2010 is $29,500. So let's look at the loss itself. You had a $15,000 loss because you're going to take the lesser of the difference in fair market value or your cost. Well, your cost is $20 and the fair market value on the date of the theft is $15. The difference between $15 and what you have left when it's all done is, of course, is 0, so the loss becomes $15. You then look at your insurance reimbursement, subtract that out, and when you're done, you end up with a $2,000 loss. The next rule from IRS is to subtract the $100, and then we subtract the 10% of AGI. So the loss after subtracting $100 is $1,900, but when we look at 10% of AGI, that's $2,950. Ultimately, the reductions to the deduction are greater than the deduction itself, and we're left with a deductible casualty loss of 0. Let's look at another illustration, and this illustration is a two-part illustration. Firstly, we're going to have part 2A. Your home was damaged in an ice storm. A tree collapsed onto your roof, causing extensive damage to the house and the property inside. The fair market value of your home before the storm was $150,000, and the fair market value of your home after the storm was $120,000. You paid $130,000 for the home. Your belongings destroyed by the falling tree had a fair market value of $4,000 before the storm and a fair market value of 0 after the storm. Your insurance reimbursed you $9,000, and your AGI for 2010 is $29,500. So how do you go about figuring the loss for the single event? Well, we're going to look at the house and we're going to look at the belongings. Now, IRS instructions say we should list out all of the belongings separately, but for purposes of our illustration, we're going to keep it simple, but just by dividing the house and the belongings into two different categories. So the house before the event was worth $150,000. The belongings before the event were worth $4,000. So the total fair market value of the assets before the loss is $154,000. We then look at the fair market value after the loss. The house is worth $120,000. The belongings are worthless, and that gives us a total fair market value after the event of $120,000. Next step, we take fair market value before, fair market value after, and we get our total loss, $34,000. Now we bring in the insurance reimbursement. And insurance reimbursed $9,000, so we subtract that from the loss of $34,000, and we get a total loss after insurance of $25,000. Next step, we look at the total loss after insurance, which is $25,000. We apply the $100 rule, and we apply the 10% of AGI rule. After we've done that, we get a net loss to claim on the tax return of $21,950. This $21,950 is ultimately the number that would carry to line 20 of the Form 1040 Schedule A, but we would have to do the Form 4684 and attach that to the return as well. Now let's expand upon illustration 2A just a little bit with 2B. We're going to assume the same information as in 2A, except later that same year, your bad luck continues and your $1,500 ring is stolen. You have no insurance coverage for the ring. Well, now we're going to look at the same information again. The house had a fair market value before the event of $150,000. The belongings had a fair market value of $4,000, and the ring had a fair market value of $1,500. So the total fair market value before the losses were $155,500. How much are our assets worth after the loss? Well, the belongings and the ring have no value at all. They're gone. The house is still worth $120,000, so the fair market value after the loss is $120,000. Next step, we look at the fair market value of assets before and the fair market value of assets after, and we end up with a total loss of $35,500. Total loss after insurance reimbursement, well, it's that same $9,000 of insurance reimbursement. Our loss goes to $26,500. Now it's time to apply the $100 per event rule and the 10% of AGI rule. We take the total loss after insurance of $26,500. We subtract out $100 for the falling tree event. We subtract out $100 for the stolen ring event. And we then subtract 10% of our adjusted gross income, and that gives us $2,950. and the allowable casualty loss deduction is $23,350. So let's next talk about when to deduct a loss. We have the type of loss and the year in which to deduct the loss. Let's talk about losses on deposits first. A deposit that is treated as a casualty loss is deducted in the year you reasonably estimate that the loss occurred. A loss that is claimed as a bad debt, you claim that loss in the year the deposit became totally worthless. And if you are claiming a lost deposit as an ordinary loss, you claim that loss in the year you reasonably estimate the loss occurred. If you are claiming a loss from a casualty, you claim that loss in the year the loss occurred. If you are claiming a casualty loss in a federal disaster area, you can claim the loss in the year the disaster occurred or in the year immediately before the disaster. So many hurricanes produce national disaster areas. Of course, we've had floods in the Midwest, and those are events that are typically classified as federal disaster areas. If you are dealing with a loss in a federal disaster area, one of the special treatments that's allowed is that the loss can be claimed in the year that it occurred or the year immediately before the disaster. And I've never really been provided information on why this is the case, but I kind of look at the situation and have decided that the reason for that could be such a bad loss that the economy is devastated and no one goes back to work for several months. And so your income in the year of the loss is much lower. Well, it might be good to claim a loss in the year that your income is lower because that 10% threshold number would be a smaller number and do you more good. On the other hand, you might find that circumstances mean that it's better for you to claim the loss in the earlier year. It might produce a bigger refund or have some other better tax benefit for you in the earlier year. The IRS is saying that you can claim that loss either in the year of the loss or the year immediately before the disaster. If your loss is from a theft, you claim the loss in the year that the theft was discovered. Next up, we have a federally declared disaster area. If you live in a federally declared disaster area, you are given special treatment. These losses are subject to the 10% of AGI limit under deductible only if you itemize your deductions. These losses are also subject to the $100 per loss limit. You can claim the loss on your tax return for either of the following years: the year that the casualty occurred or the year immediately preceding the year that the casualty occurred. Also, if you live in a federal disaster area, interest will be abated. The IRS will abate interest on taxes you owe for the length of your extension if you meet the following requirements. Number 1, you were located in the area declared a disaster by the federal government. And 2, you were granted an extension of time to file your taxes and you paid your income taxes. The 10% limit on losses does not apply for certain losses in 2008 and 2009. The 10% of AGI limit rule does not apply for losses from a disaster declared a federal disaster in years after 2007 and before 2010. This loss is deductible in 2010 only if you meet both of the following conditions. You could not deduct the loss in the earlier year in which it occurred because you were not sure whether the loss would be reimbursed, by insurance for example, or you became reasonably certain in 2010 that the loss would not be reimbursed. The net disaster loss, the excess of line 2 over line 1 in the worksheet for line 17 of Form 4684 is not subject to the 10% of adjusted gross income limit. Your net disaster loss is deductible as an itemized deduction on Schedule A or as a part of your standard deduction on Schedule L. So this is pretty much a rule that was in effect for 2008 and 2009 only. There'd be very, very few people who would have had a loss in 2009 or 2008 but not end up claiming it until 2010. So it's a fairly small group of people that that particular rule applies to. Now, for most years, we have the 10% of AGI rule and we have the $100 rule. But for losses that occurred in 2009, the $100 rule was changed to be a $500 rule. So if your loss occurred in 2009, then the $100 deduction or the $100 amount that was not allowed as a casualty loss was increased to $500. So where do you deduct your personal casualty loss? Well, you deduct a non-business casualty loss by completing Form 4684, Section A, and attaching it to your Form 1040 tax return. You claim your loss on line 20 of Form 1040, Schedule A. And here is our next password of the day. The password to open the Session 7 quiz answer key is Skywalker, Skywalker, as in Luke Skywalker of Star Wars. Here is Form 4684. You can see that the form is divided into multiple lines, and you can see Property A, Property B, Property C, Property D, and those correspond to these columns. So what you should know, though, is that you would use a separate Form 4684 for each event. If you lose multiple pieces of property in the same event, then they are listed on line A, B, C, D, etc. But if you lose property in multiple events, then you would list property for each event on separate Forms 4684. Now you see that the form provides space for you to enter the cost or other basis in the property, the insurance or other reimbursement, gain from casualty or theft. It is possible that insurance will actually give you a gain. Fair market value before the casualty or theft, fair market value after the casualty or theft, and then, of course, we enter the smaller of lines 2 or line 7. Next, we move over to line 11, where we enter the smaller of line 10, or $100. That's how we apply the $100 rule. And there would be $100 applied to each separate Form 4684. The next step is to calculate 10% of our adjusted gross income, and we enter 10% of our adjusted gross income on line 19. So we would have a separate Form 4684 and apply the $100 rule on each separate form, but ultimately we total up the net loss from each of the forms, and then on line 19, on one of the forms only, we enter 10% of the adjusted gross income. We finally get the loss on line 21 and carry that over to line 20 of the Schedule A. Net operating losses. If your casualty or theft loss is more than the income you may have, a net operating loss, you can carry an NOL back to a prior year to get a refund of taxes you already paid, or you can carry your loss forward to next year. Net operating losses are a fairly complex calculation with very specific, lengthy, detailed instructions on how to figure them and enter them on a tax return. They're well beyond the scope of this course. So if you do have a client who possibly does qualify for a net operating loss, then I would recommend that you consult tax experts with more experience or spend a great deal of time boning up and researching net operating losses, how to figure those. Damage from corrosive drywall. This is just a special piece of information we wanted to give you. Under a special procedure, you may be able to claim a casualty loss deduction for amounts you paid to repair damage to your home and household appliances that resulted from corrosive drywall. You should refer to publication 547 for more information about that. Now, I'm calling up on the screen now a table. This table comes from IRS publication 547 on casualty and theft losses. It shows the deduction limit rules for personal use and employee property. So the 10% rule applies to loss of personal use property, but you might be subject to a 2% rule instead if it was employee business use property. So let's look at the general rules that apply. You must reduce each casualty or theft loss by $100 when figuring your deduction. Apply this rule to personal use property after you have figured the amount of your loss. You then move on and calculate the 10% rule. You must reduce your total casualty or theft loss by 10% of your adjusted gross income. You apply this rule to personal use property after you reduce each loss by the $100 rule. Under the 2% rule, you must reduce your total casualty or theft loss by 2% of your adjusted gross income. Apply this rule to property you used in performing services as an employee after you have figured the amount of your loss and added it to your job expenses and most other miscellaneous itemized deductions. You apply the $100 rule only once to any single event, even if many pieces of property are affected. Under the 10% rule, you apply the 10% rule only once, even if many pieces of property are affected and you have multiple events. Under the 2% rule, you apply this rule only once, even if many pieces of property are affected over multiple events. If there's more than one event, you apply the loss from each event, so it's a $100 rule to each event, but not to each piece of property within an event. The 10% rule is applied to the total of all of your losses from all events, And the 2% rule is applied to the total of all of your business losses, your employee business losses from all business events. More than one person with the same loss from the same event, other than a married couple who are filing a joint return, you would apply the $100 rule separately for each person, and you would also apply the 10% rule separately for each person. And if you were claiming it as an employee business expense loss, then you would apply the 2% rule separately for each person. But if you are filing a return for a married couple who have a loss from the same event, and they are filing a joint return, you would apply the $100 rule as if there was only one person. And you would apply the 10% rule as if there was only one person. And if the loss were an employee business expense loss, you would apply the 2% limit as if there was only one person. But if you have a married couple with a loss from the same event and they file separately, you would apply the $100 rule separately to each spouse, as you would apply the 10% rule or the 2% rule, whichever was appropriate, separately to each spouse. If there is more than one owner other than a married couple filing jointly, you apply the $100 rule, the 10% rule, and the 2% rule separately to each owner of the property. Now please note that the 10% rule does not apply to a net disaster loss from a disaster declared a federal disaster in tax years beginning after 2007 and before 2010. So for today's class, we've been looking at non-business casualty losses, but I did want to draw your attention to situations where casualty losses can be experienced in a business way, and that tax treatment for business casualty losses is different than tax treatment for non-business casualty losses. So let's take a look at the losses on business or income-producing property, just to kind of give you a reference. We're not going to spend any time calculating business casualty losses, but we at least wanted you to be aware of some of the important differences. If you incurred a casualty or theft loss in your trade or business, different limits apply as follows. Firstly, the $100 and 10% rules do not apply. If the loss occurred to employee business use property, you claim the loss as a miscellaneous itemized deduction subject to the 2% limit. If the loss is associated with a business activity reported on Schedule C for self-employment, or Schedule F for farming, or Form 1120S S Corporation, or Form 1065 for a partnership, then, if the property was completely destroyed, the loss is generally the cost of the property minus accumulated depreciation. Fair market value that is less than basis does not reduce the allowable loss. But if the property was damaged but not destroyed, then the loss is generally the decrease in the property's fair market value up to the adjusted basis. So this particular rule for non-business losses is that the loss is the lesser of the decrease in the fair market value or the cost basis. But when we're dealing with business use property, we have to factor in whether the property was completely destroyed or just damaged and not destroyed. And if the property was completely destroyed, the loss is generally the cost of the property minus accumulation, because fair market value that is less than basis does not reduce the allowable loss. And if the property was damaged but not destroyed, then the loss is generally the decrease in the property's fair market value up to the adjusted basis. So that concludes the portion of today's lecture that is devoted to a discussion of casualty losses and the rules that apply to casualty losses. In general, the rules surrounding casualty losses are not dreadfully complicated. You need to pass the 10% of EGI rule. You have to apply the $100 test. You have to have a loss that is deemed to be either a casualty or a theft loss, and we've provided you with the rules for that. And you then use Form 4684 to figure the loss. You then figure the loss and enter the loss on line 20 of Schedule A. But we're going to move down Schedule A to take a look at other miscellaneous itemized deductions. So virtually all of Session 8 was devoted to a discussion of employee business expenses and how to determine the deductibility of expenses and to complete Form 2106. Today we're going to look at other kinds of miscellaneous itemized deductions, including tax preparation fees that are reported on line 22, other expenses that are subject to the 2% limit on line 23, and other deductions that are allowable that are not subject to the 2% limit, and those are entered on line 28. So as a reminder, miscellaneous itemized deductions generally relate to expenses you incur as an employee or are related to other income production such as investment or hobby income. The most common items claimed as miscellaneous deductions include unreimbursed employee expenses for car, travel, meals, entertainment, and education, job search expenses, union dues, tax advice and preparation fees, safe deposit rental when the box contains investment property, hobby losses to the extent of hobby income, and gambling losses to the extent of gambling winnings. Just as a reminder, what is the 2% limit about? Well, most miscellaneous deductions are subject to a 2% limit, and this means you must subtract 2% of your AGI from your total allowable expenses, and you then get to deduct what is left. The 2% limit is restrictive enough that most people are able to claim little or no miscellaneous deductions unless their expenses are fairly substantial. Well, when we go over to the Schedule A, we remember that the 7.5% that applies to medical is really the most onerous of the limits. 7.5%, almost no one makes that limit. But miscellaneous deductions, even though 2% can be a good number, there's still plenty of taxpayers out there who routinely exceed that limit and end up being able to claim their expenses on line 27 of Schedule A. So let's take a look again at other miscellaneous deductions. Certain deductions not associated with employee business expenses may be deducted on Schedule A. Following are some of the other miscellaneous expenses you may be able to claim as an itemized deduction. Remember that miscellaneous expenses are divided into two categories: expenses subject to the 2% limit and expenses not subject to the 2% limit. So firstly, we're going to look at employee expenses that are subject to the 2% limit and how you go about claiming them. Firstly, we have unreimbursed employee business expenses, and they are typically claimed on Schedule A, line 21, and Form 2106 is completed if required. And employee business expenses include meal and entertainment expenses, travel, auto, educational expenses, office use of home, business liability insurance, and damages for breach of contract. I just wanted to remind you that meal and entertainment, travel, and auto are required to be entered on Form 2106 first, but educational expenses, business use of home, business liability insurance, and damages for breach of contract can go directly on Form Schedule A without attaching Form 2106, unless Form 2106 is already required because one of these items is being claimed. You can also claim depreciation on computers your employer required you to use for your work. And if you claim depreciation on a computer, you need to complete Form 4562, Depreciation and Amortization, and then carry the depreciation deduction to line 21 of Schedule A. Dues to Chambers of Commerce, those are claimed on Schedule A or Form 2106 if it is otherwise required. Dues paid to sports clubs or other socially based facilities are not deductible at all. This is a rule that has been in place since 1993. Job search expenses, licenses and regulatory fees, occupational licenses, repayment of income aid payment, research expenses of a college professor, tools with a life of 1 year or less are all claimed on Schedule A, line 21, unless Form 2106 is otherwise required. But if you have tools with a life of more than 1 year, you would enter those on Form 4562, claim a depreciation deduction using Form 4562, and then enter the deduction on line 21. Union dues, work clothes and uniforms that are not suitable for everyday wear, and protective clothing and safety equipment, those are all claimed directly on Schedule A, but if Form 2106 is otherwise required, you would enter the deductions on there first. I wanted to point out some specific rules relating to military uniforms, particularly if you're living in an area where you're preparing tax returns frequently for people who are members of the military. It is important to get this down. I have the benefit of being a Navy wife in my early marriage. My husband is no longer in the military, but when we first married, he was in the military, and so I kind of get some of the stuff that's going on. And if you live in a military town or are closely involved with the military, it should make sense to you as well. Military uniforms for active duty personnel. Well, the formal uniforms they purchase are not deductible, but fatigues are deductible only to the extent that the cost of buying and maintaining the uniform exceeds any uniform allowance that you receive. If you have deductible military uniforms, you claim those on Schedule A or on Form 2106 if otherwise required. And why are formal uniforms not deductible? I can only relate back to my personal experiences with my own husband, and that is that the formal uniforms were considered to be street attire and that they would wear those out on the street, certainly for weddings and for meetings and so forth. But fatigues and flight suits and uniforms of that type were typically not supposed to be worn off base. And so to me, it makes sense that there's a difference between these, because the general rule about the deductibility of uniforms is they cannot be suitable for everyday wear, and if you're a military person wearing your dress uniform, you can wear that off base. Now, military uniforms of reservists are deductible to the extent that you are not reimbursed by the military and that the clothing cannot be worn when you are not on duty. So there is a restriction around that, and that restriction means that the uniform is not suitable for everyday wear because you're not allowed to wear it for everyday wear. And if you are able to claim the deduction as a military reservist for the cost of your uniform, you do so on Schedule A or on Form 2106 if it is otherwise required. Next up is tax preparation fees that are subject to the 2% limit, and those are claimed on Schedule A on line 22. Tax preparation fees are deductible as they relate to the personal preparation of your tax return. But fees relating to preparation of business income or rental income, those are claimed differently. So to give you an idea of what is going on with this tax preparation fee and where to deduct the cost of preparing your tax return, I've done a quick illustration here. And let's suppose that the total tax preparation fee is $350. So you have a client, you're charging them $350 to prepare their tax return. Well, in the billing, you should be able to divide out how you arrived at the fee. And let's suppose that when you do that, the personal portion of the cost of the tax preparation is $150. The cost of preparing Schedule C for a business self-employment filing and other forms related to Schedule C is an additional $100. And then the cost of preparing Schedule E and other related rental forms is also $100. So ultimately what would happen is you would claim the $150 as a deduction on next year's tax return. You would claim the $100 for Schedule C preparation on next year's Schedule C, and you would claim the cost of preparing this year's Schedule E as a rental expense on next year's Schedule E. So just as a recap, the individual cost of tax preparation is included on Schedule A, line 22, but fees relating to preparation of business or rental income are broken down and entered in a pro rata basis on Schedule C and E as appropriate. Next, we're going to look at other allowable deductions that are subject to the 2% limit. And other expenses that are deductible include things like appraisal fees for donated property or to compute the cost of a casualty loss. Those are entered on Schedule A, line 23. So the space on line 23 allows you to describe what it is that you're deducting. You then total up those deductions and enter them on line 23. The cost of casualty or theft loss of business property used by you as an employee, well, you would complete Form 4684, lines 31 and 33B and or 38B, or Form 4797, line 18A. This is really beyond the scope of today's course. I'm not going to go into those forms and what you need to do in terms of filling out those additional forms and lines, but it's safe to say if you have a business loss, you're going to need to do additional work beyond the scope of today's class. When you figure the deduction, though, you enter it on Schedule A, line 23. Clerical help and office rent connected with investment income, enter that on Schedule A, line 23. Depreciation of home computer to manage investments, complete Form 4562, depreciation and amortization. Excess deductions of an estate, enter those on Schedule A, line 23, and refer to Publication 559 for more information. Fees to collect interest and dividends, hobby expenses to the extent of hobby income, indirect deductions of partnerships and S corporations and non-publicly offered mutual funds, and investment fees and expenses are all entered on Schedule A, line 23. Legal expenses paid to produce or collect taxable income, they are entered on Schedule A if they are personal expenses on line 23, but if they relate to your self-employment income, then you would enter those on Schedule C. A loss on deposits with insolvent or bankrupt financial institutions, you can enter those on Schedule A, line 23, or Form 4684, casualty and theft loss, Schedule A, line 20. A repayment of income of $3,000 or less, or a repayment of Social Security benefits that is greater than benefits received by $3,000 or less, or a safe deposit box used to store taxable income-producing documents, or service charges on dividend reinvestment plans, or the administrative fees of a trustee for management of your IRA. These are all deducted on Schedule A, line 23, but I did want to point out that the IRA fees of a trustee have to be paid from non-IRA sources to the custodian. So some people pay their IRA fees directly out of pocket to the custodian so that they can then deduct them on Schedule A. But if the trustee fees are paid from money inside of the IRA, then they are not deducted on Schedule A. Moving on, miscellaneous deductions not subject to the 2% limit. Well, we have a series of deductions here, that most of which are fairly uncommon. The most common types of miscellaneous deductions are subject to the 2% limit. There are some other deductions that are not subject to the 2% limit. That's what we're going to talk about now, but you will see that most of them are going to seem rather foreign in their description to you, and that's because they're just simply reserved for a specific type of loss or event that is not normal. And they include amortizable premium of taxable bonds. You claim that on Schedule A, line 28. Casualty and theft losses from income-producing properties such as stocks, vacant land, and works of art. First report the loss on Form 4684, Casualty and Thefts, line 31 and 33 or 38B, and then carry it to Schedule A, line 28. Form 4797, Sale of Business Property, may also apply, and we will discuss Form 4797 later on in the course. Federal estate tax on income in respect of a decedent, that is also deductible on this line. You should refer to Publication 559 for more information. Of the items listed here, gambling losses up to the amount of gambling winnings are probably one of the more common items that we'll come across. If you report gambling winnings, you report those on line 21 of Form 1040, and you are allowed to claim losses to the extent of winnings included in income on line 28 of Schedule A. Impairment-related work expenses for individuals who have physical or mental disabilities. So if you are preparing a tax return for a person who has a disability and they have work-related expenses to help them work, they are allowed to claim those expenses. Sometimes Form 2106 may be required, but either way, they're not subject to the 2% limit and they go directly on line 28. Now, repayments under a claim of right greater than $3,000, including repaid wages, and repayment of Social Security benefits is greater than benefits received by more than $3,000, these types of repayments are not subject to the 2% limit. So it may seem strange to you, it always has to me, but if you repay wages or you repay Social Security benefits and the amount you repay during the year is more than $3,000, you are allowed to claim that deduction on Schedule A and not reduce it by a 2% limit. But if the amount you repay is less than $3,000, you are subject to the 2% limit. Unrecovered investment in an annuity on final return of a decedent, that is deductible on line 28, not subject to the limit. Officials employed by a state or local government on a fee basis, first complete Form 2106 or 2106EZ, and then on Form 1040, line 24, write FBO and the amount of the expense from line 10 of Form 2106 or line 6 of Form 2106EZ. So that obviously is what we discussed earlier in our course under adjustments to income. We talked about fees of government official and that those could be claimed as an above-the-line deduction. And then travel expenses of reservist and National Guard service members who travel more than 100 miles away from home overnight. These are also an item that we discussed earlier in our course under adjustments to income. And if you have expenses, travel expenses of a reservist traveling more than 100 miles away from home overnight, you complete Form 2106 and then you figure the portion of the expenses on Form 2106 that are allocable to the overnight travel and carry those to the front page of 1040, and the remaining expenses carry to line 21 and are subject to the 2% limit. Now here is an example or illustration of how we have prepared a Schedule A claiming a variety of different itemized deductions. The character's name is Hugh Grant, and he has adjusted gross income of $172,000, and he had the following expenses. Gambling losses to the extent of gambling winnings, and you can see that we've entered those on line 28, not subject to the 2% limit. He had a tax preparation fee of $250, and we've entered that on line 22. He had deductible educational expenses. That does not require completion of Form 2106, so we entered it directly on line 21. And then he had deductible hobby expenses of $500. We entered hobby expenses on line 22. Hobby expenses are deductible to the extent of hobby income. Hobby income is reported on line 21 of the 1040. Hobby expenses up to hobby income, but not more than hobby income, are entered on line 22 and are subject to a 2% limit. Let's look now at a variety of deductions that people frequently think might be deductible, but the IRS is going out of its way to say no, they are not. And this list begins with broker's commissions that are paid in connection with your IRA or other investment property, not deductible. Burial or funeral costs, also not deductible. Capital expenditures such as equipment, building, and other assets that you might purchase. Fees and licenses, including car, marriage, and pet. Hobby losses. You are allowed to claim hobby expenses to the extent of income, but you are not allowed to claim losses. Home repairs, insurance, and rent, except as allowed under the rules for home office expenses as unreimbursed employee business expenses. Illegal bribes and kickbacks. Loss on the sale of personal property such as your home, car, or other personal property not used for business. Personal disability insurance premiums are not deductible. Personal living or family expenses not deductible. The value of wages never received or lost vacation time. I can't tell you how often I get asked about this one. Well, can't I claim a deduction for the money I never made? Or can't I claim a deduction for the value of my donated time? Well, although it may seem logical that you should be able to claim a deduction for the loss of your time, think back a little and remember that if you did not include wages in your income, then you've never paid tax on the wages you didn't make. Therefore, you have no tax basis on which to claim a deduction. Campaign expenses are not deductible even if the candidate is running for re-election. Check writing fees on a personal account, not deductible. Club dues, including clubs where you meet to discuss business. Commuting expenses, fines or penalties. Health spa expenses are not deductible even if your job requires excellent physical conditions such as a law enforcement officer. Home security system is not deductible except as allowed under home office expenses. Homeowners insurance premiums are not deductible except as allowed under home office expenses. Investment-related seminars, not deductible. Life insurance premiums. If you pay premiums on policies assigned to your former spouse, they may be treated as alimony. Lobbying expenses and lost or mislaid cash or property are not deductible. Lunches with coworkers, except when you are traveling for business or otherwise qualify to claim entertainment expenses. Meals while working late, these are not deductible except when they qualify as travel or entertainment expenses. Personal legal expenses incurred for such thing as child custody, breach of promise, civil or criminal charges, personal injury, preparation of will, or divorce. Political contributions are not deductible. Professional accreditation fees, that is the initial fee you pay to become accredited as an accountant, lawyer, doctor, or tax preparer. Now, if you are already a tax preparer, working as a tax preparer, and you now have to pay for continuing education or you now have to pay for IRS registration, those fees would become deductible. But if you've never been a tax preparer before, you are entering the industry for the first time, and you are required to get a PTIN number to begin working in a new profession, that is not deductible. Professional reputation. Money you pay to improve your professional reputation, such as expenses of TV and radio appearances, not deductible. Relief fund contributions. Residential local telephone service is not deductible even if you use your phone for business. To claim a telephone business expense, you must have a second phone line installed in your home for business use. The rationale of our government is that you would have your regular phone line anyway, but this particular rule has been in place and has not changed in decades. And so what we deal with in the real world today is many people don't have a home phone line at all. They're using their cell phone, and they're using their cell phone for personal and for business. And the interesting thing is about cell phone usage, the IRS does allow you to prorate based on personal versus business use. But when it comes to your home phone line, even if you use the home phone for business, the IRS says you'd have the line anyway. And I say, of course, lots of people don't have a home line anyway and could very reasonably and legitimately have a home line for business purposes only. But the IRS is saying no, so I really wouldn't push that one. So how do you work your way around the residential phone line issue? Well, you'd have to have 2 phone lines installed in the home, one for business, one for personal. But if you have only one line coming into your home and then you use that line for business, and because you use it for business you have some add-on features to help you with your business, those add-on features could be deductible. The cost of stockholders' meetings, the cost of attending those is not deductible. Tax-exempt income expenses. You cannot deduct expenses you paid to produce tax-exempt income. Travel expenses for another individual, such as your spouse, friends, or family members, are not deductible. Voluntary unemployment benefit fund contributions, such as those you might make to a union fund or a private fund, are not deductible. However, state unemployment taxes you might pay are deductible as taxes paid. So for example, certain states like California have a California State Disability Fund, and those are deductible, but if you were just paying into a voluntary unemployment fund, those are not deductible. And finally, wristwatches. Nice try. Here's my wristwatch. I get asked about this all the time. Even if your job requires you to be on time and to have accurate timekeeping device with you, the IRS says no to that. Okay, limits on itemized deductions. Every year since 1991, the amount of itemized deductions that a taxpayer can claim has been reduced to the extent that the taxpayer's adjusted gross income is above a certain amount. For 2009, that threshold amount was $166,800. And when your income exceeded that amount, for all these earlier years, your itemized deductions started to phase out. The most that they ever phased out by was 80%, and it took a long time, and essentially a person with really high income, to ever hit that 80% phase out. But for tax years 2010 through 2012, the limitation on itemized deductions is repealed. This is a temporary provision, and it affects and benefits only those filers who are earning more than $166,800. So essentially what you may notice on Schedule A for 2009 and earlier years is a portion at the bottom of Schedule A that says, what is your income? If your income exceeds this amount, complete a worksheet to figure out how much you're going to be allowed to claim as an itemized deduction. Well, for 2010, 11, and 12, that particular part of the page is gone. So if you are looking at old year tax returns, you might observe that section, and I just wanted you to be aware of what it was there for. And then essentially, beginning in 2013, that phase out is due to return. So the next topic I'm going to talk about today is the alternative minimum tax. And an in-depth discussion of AMT would take at least 4 hours to really teach you how AMT works and some of the rules that surround it, to any depth where you really started to grasp it. But the IRS has said, at least in a webinar that I attended back in March of this year, that they do intend to test, or at least they offered alternative minimum tax as a topic on which they felt a tax preparer should have some knowledge. So I wanted to make sure we touched on AMT so that you are familiar with the concept behind AMT and some of the income or deduction items that might trigger the alternative minimum tax. Well, how does alternative minimum tax work? Let's just refresh ourselves on how the regular tax works. Under the regular tax, you report your income and you report your deductions on Form 1040. And when you get over to page 2 of 1040, you claim either a standard deduction or you claim itemized deductions. And you're allowed to claim personal exemptions, and you then arrive at your taxable income and figure your tax. Well, you'll notice that line 45 of the form has an entry for alternative minimum tax. It says, see instructions and attach form 6251. Well, 6251 is a 2-page form with multiple lines, and as I said, it would take a full 4-hour class to really delve into it. But for today, we're going to describe some of the situations that can trigger AMT so that you are at least familiar with that. You may have to pay AMT if your taxable income for regular tax purposes combined with certain preference items is greater than a certain amount. If you are affected by AMT, tax benefits received through claiming certain itemized deductions and other deduction items is minimized or eliminated. To calculate your adjusted gross income for alternative minimum tax purposes, you must add the following adjustments and preference items back into your income first. And these are the things that are not deductible under alternative minimum tax. They include personal exemptions. So on your personal return, if you listed yourself, you listed your exemption, or maybe you listed dependents and you're claiming deductions for those, under AMT you can't claim those deductions. They get thrown out. Also the addition of the standard deduction. So under alternative minimum tax, you're not allowed to claim the standard deduction. You're allowed to claim certain itemized deductions, but if you claimed the standard deduction, under AMT you're not allowed to claim that deduction. Under the category of itemized deductions, you are allowed to claim certain deductions, but others you are not. Deductions you are not allowed to claim under AMT include state and local income taxes, certain interest, most miscellaneous deductions, and part of medical expenses. Subtraction of any refund of state and local taxes that was included in your income. So under AMT rules, you are not allowed to claim the deduction for state and local income taxes, and if you included a taxable state refund in your income on line 10, under AMT they'll be nice enough to say you don't have to pay tax on that part. Also, changes to accelerated depreciation of certain property. So we're going to learn about depreciation later on in our course, and we're going to learn about how depreciation works and how you figure deductions. Well, under AMT, some of the accelerated methods of depreciation are disallowed, and so AMT depreciation can be different than regular depreciation. There are also differences in the gains or losses on the sale of property that are reported for regular tax purposes and AMT purposes, yet addition of certain income from incentive stock options. Those are taxed differently under AMT. Change in certain passive activity loss deductions. There are more restrictions affecting passive activities, and we're going to learn what passive activities are and how they work later in our course. But if you have a person who is subjected to AMT, passive activity loss limits may have further complications for a person who is subjected to AMT. Also, addition of certain depletion that is more than adjusted basis in the property, addition of the part of the deduction for certain intangible drilling costs, and the addition of tax-exempt interest on certain private activity bonds. So we learned about tax-exempt interest, but under the rules for AMT, certain types of tax-exempt interest are not tax-exempt, and they get added back into income. In 2010, you are subject to AMT if your taxable income for regular tax purposes, combined with certain adjustments and tax preference items, is more than your income based on your filing status. And I think the first thing you'll notice is that these income amounts are not that high. If you're married filing separately, your taxable income combined with certain adjustments and preference items could expose you to AMT when your income hits $36,225. If you're single, that threshold is $47,450, and if you are a qualifying widow or married filing jointly, that threshold is $72,450. Now, it does not mean that you will pay AMT at these income levels, but it means you are subjected to the rules for calculations of AMT, and you could be exposed to the tax with income that is beginning at these levels. The alternative minimum tax is affecting more and more people as average income levels increase over time. And in my class on alternative minimum tax, I go into a little bit of historical reference on it. And the history of the AMT was that it was first introduced back in 1969 as a method of ensuring that everybody paid at least some amount of tax. What has happened over time, though, is that the alternative minimum tax has never been indexed for inflation. So the definition of a high-income person back in 1969 was that person earned a certain dollar amount of money. And when you clock forward in time, 40 years, that definition or that income level has never been adjusted for inflation. And so people that used to be considered high income with a certain dollar amount of money would absolutely not be considered high income in today's terms, but they are being treated as if they were high income under the rules for AMT. So it's very much a punitive tax. There's a lot of political discussion. It comes up in the news frequently. And the IRS, actually not the IRS, but Congress frequently pushes through last-minute patches at the end of the year. And the most recent time that happened was December of 2010. So the IRS had to reconfigure all of its computer systems as the tax season was beginning, and it caused delays in the processing of many tax returns for people who itemize deductions and have certain other types of taxable income. So the 2010 filing occurred in the 2011 tax season, and the 2011 season was delayed over these last-minute patches, and it's happened before. So let's move on now to our classwork assignment. The classwork assignment involves Schedule A and Form 4684. We have Katrina Brewer, who is single. Her adjusted gross income is $47,229 for 2010. Her 1098 mortgage interest is $5,000, and her property taxes were $1,000. She had $1,829 of state withholding on her W-2. On June 15, 2010, Katrina's personal belongings and car were destroyed by flooding. At the time of the flood, she lived at 123 North Pacific Street in South Egremont, Massachusetts. She had the following losses in 2010. We show her house has a basis of $200,000, a fair market value before the event of $230,000, and a complete loss. It's worth nothing after the event. Insurance reimbursed her $185,000. She also has personal belongings that were valued at $45,000, or actually had a cost of $45,000. They had a fair market value before the event of $29,000 and a fair market value after the event of $27,000. She also lost her car. It cost her $26,500. It had a fair market value of $15,000 and was worthless after the event. Insurance reimbursed her $11,000. Please go ahead and prepare her Schedule A and Form 4684. So at this point, please push pause on the lecture video, complete Form 4684 for Katrina Brewer, and when you are finished with your classwork, please resume video playback for a review of the answer key. And here is the answer key for Katrina Brewer. Just as a review, Katrina's casualty loss results in a net $20,900 loss. So if you came up with a $20,900 loss, good for you. Her AGI was $47,229. 10% of her AGI is $4,723. Her loss is more than 10% of her income, and therefore her allowable loss for tax purposes is $16,177. So let's go ahead and take a look at her finished Schedule A and Form 4684. And here is Katrina Brewer's Form 4684. So let's take a look at that. Firstly, she has 3 specific losses we're discussing, but they all occurred with the same event, so they'll all go on the same Form 4684. Now, IRS instructions state that all individual pieces of property should be listed separately. For simplicity's sake, we've lumped all of her personal contents of her home onto one line, but the IRS did say you should list each piece of furniture, all the clothing, the bedding, list those things out. And then the Ford Explorer, we've given its own line as well. So we have essentially 3 separate listings of property, and they are allocated to these 3 columns. The first line, line 2, we enter the cost or other basis of the property. On line 3, we enter the insurance reimbursement. Then on line 5, we enter the fair market value before the casualty. And you'll see that for the house had a fair market value that is greater than the basis, but for the car and the belongings, the fair market value is less than the basis. We then enter on line 6 the fair market value after the event, and in all 3 cases the fair market value is they're worthless. They have no value anymore. And then on line 7, we subtract line 6 from line 5 and enter that difference. So line 6 minus line 5 is the amount shown here. Now on line 8, we enter the smaller of line 2 or 7, and this is where the adjusted basis of the house comes in. You will see that on line 7, we have a bigger number, but we're not going to be allowed to claim that bigger number because our loss is limited to our basis, because it's the lesser number. But in terms of the personal property, we're going to claim that amount of fair market value before the event because the fair market value was less than the cost, and the same thing goes for the Explorer. The fair market value was less than the cost, and so we're getting that lesser number. We then go through and subtract out the insurance reimbursements to come up with the net loss that's going to be claimed on line 9. So the insurance reimbursement shows on line 3. We're going to subtract line 3 from line 8 and enter that difference on line 9, and we end up with $15,000. So we have $15,000 is the loss on the house, $2,000 is the loss on the personal property, and $4,000 is the loss on the vehicle. Those total losses are $21,000. We now apply the $100 limit and come up with a deduction, or a loss rather, of $20,900. The next step is to apply 10% of adjusted gross income. That is entered on line 19, $4,723, and that arrives us at our net loss of $16,177. We then go up to Schedule A and enter all of the other items that we had for her to deduct, including income taxes, her real estate taxes on her home, her mortgage interest on her home, and here's that casualty loss appearing on line 20. So her total itemized deductions come out to $24,006. Moving back to our manual, we'll look at the homework assignment. And while I'm on this page, I'll point out that the password to open the Session 9 classwork answer key that we just reviewed is Caspian. That is CASPIAN. The forms needed for your homework assignment include a Schedule A, Form 1040, 4684, and 8283. Jim Kirk is single and living at 1701 Enterprise Drive in Bozeman, Montana. He has a son, Mark, who lived with him all year. Jim is a starship captain for Starfleet, and his W-2 is attached. He won $59,250 in the state lottery. He donated the following items to charity. He had a comic book collection valued at $50,000 that was stolen, and his records show that his cost basis was $30,000. He acquired the collection in 1991, and he received a $5,000 insurance payment on the loss. He also had a pet tribble that ate his prize stamp collection. The collection was originally required in 1989 and was a complete loss. The collection had a fair market value of $2,000 and a cost basis of $500. It was not insured. He had the following expenses for the year. Please sort through those and figure out what he is allowed to deduct and what he is not, and prepare his tax return. Here is Jim's W-2. And that's it. We are finished with Session 9. Have a good time with your homework assignment. Any questions relating to today's session, please use the Q&A forum to ask them. Thanks for participating, and I'll see you back at Session 10. Bye-bye.